When you hear the name Warren Buffett, you probably think of timeless businesses, things like railroads and Coca-Cola. But what about the tech world? Can that same old-school wisdom actually work in today's fast-paced market? Well, in this explainer, we're going to put that exact question to the test. This is it, right? This is the big question every single one of us is trying to answer. How do you cut through all the noise and all the hype to find something with real, lasting value? And just as important, how do you make sure you don't overpay for it? So to figure this out, we're not going to just talk in theory. No, we're going to get our hands dirty. We're going to run a full-blown analysis, just like a value investor would, on a real, live company that's kind of like the hidden plumbing of the internet, F5 Networks.
So here's our game plan. First, we'll get a handle on Buffett's basic framework. Then we'll just walk right through it, step by step, applying it to F5's business, its leaders, its financials, and of course the price, before we land on a final verdict.
Okay, first things first. Let's be clear. Buffett's method isn't some kind of magical black box. It's actually a really disciplined framework built on what you could call 4 key pillars. Just think of them as a checklist you can use to find great companies.
All right, let's jump into pillar number 1, the business itself. The first thing Buffett wants to know is, does it have a moat? Like a real moat around a castle? It's some kind of durable, competitive advantage that protects it from invaders. And for a business, that means protecting its profits. For Buffett, this is an absolute must-have.
So, what is this moat he's always talking about? Well, it's something that makes the business special and hard to compete with. It could be a super strong brand, a key patent, or maybe they're the cheapest producer. Or, in F5's case, it's just a huge pain for customers to switch away. It's the secret sauce that lets a company stick around for the long haul.
And this really sums up F5's situation. On the one hand, their moat is pretty wide. Once a big company weaves F5's products into their critical IT systems, pulling it out is a massive, expensive headache. That's a powerful switching cost. But, and this is a big but, that moat isn't unbreachable. You've got new cloud-native competitors and open-source software that are definitely a real threat.
Okay, on to pillar number 2, the management team. Buffett has this great analogy where he says he wants a good horse, but he needs a great jockey riding it. He's talking about the leadership. Are they straight shooters? And maybe even more important, are they smart with the company's and the shareholders' money?
So, what does F5's management actually do with all the cash this business generates? Well, you look at their track record and it's incredibly rational. They're constantly buying back their own stock, which makes each share that's left more valuable. They pay a dividend, and when they buy other companies, they're smart, strategic buys that fit their core business, not just chasing the latest shiny object. This is exactly the kind of smart, even boring decision-making Buffett absolutely loves.
All right, we've looked at the business and the people running it. Now for pillar number 3, the financials. It's time to dig into the numbers and see if the story they're telling matches up. This is where the rubber really meets the road. And here's a number that just screams strong business, an average gross margin of 82%. Think about that. For every dollar of stuff they sell, 82 cents is pure gross profit. That's a huge sign of pricing power. It tells you that customers really value what F5 does, and they're willing to pay up for it. Next up, return on equity. This basically measures how well the company uses shareholders' money to make more money. And F5 is consistently in that 15 to 20% range that Buffett really likes to see. But you can see it right there on the chart. That number has been under a bit of pressure lately, which reflects those competitive challenges we talked about. So it's good for sure, but maybe not perfect. Now this is a number that screams safety. A debt-to-equity ratio of just 0.15. That is incredibly low. F5 has what you'd call a fortress balance sheet. They have almost no debt, which gives them a ton of flexibility to handle anything the economy or their competitors throw at them. This is a massive checkmark in the Buffett playbook. Okay, this is it. This is the moment we've been working towards. We've got a good business, rational managers, and really strong financials. But what's it actually worth? This final pillar is all about the price. It's about figuring out its true intrinsic value and seeing how that compares to its price tag on the stock market. The way we do this is with something called a discounted cash flow analysis, or DCF. Now, I know, it sounds complicated, but the core idea is really simple. A business is just worth all the cash it's going to produce from now until forever. So all we do is guess what that future cash will be, and then we pull it all back to what it's worth in today's dollars. It's really just these 4 steps. And after all that math, here's the big reveal.
Our analysis suggests that F5 Networks is intrinsically worth somewhere in the ballpark of $215 to $235 per share. Now, you compare that to what it was actually selling for on the market, just a little over $161. That gap, right there, is exactly what a value investor is hunting for.
You see, that gap between what it's worth and what it costs gives us the holy grail of this whole process, a margin of safety. In this case, it's a very healthy 27 to 31%. This is your cushion. It's your built-in protection in case you're a little wrong in your assumptions or if the business hits a rough patch.
There's a quote from the source material that just sums this up perfectly. F5 might not be a totally flawless, wonderful company with a moat that nobody can ever cross, but at this price, it looks like a very good company that's selling for a wonderful price.
So, we've gone through all 4 pillars. We've sized up the moat, judged the management, decoded the financials, and calculated the value. Now it's time to put it all together. What's the final verdict? Is this a buy or not?
I think this scorecard really lays it all out. The business itself, the moat, gets a B+. It's good, but it's dealing with some disruption. Management gets a solid B for being smart capital allocators. The financials get an A-. That cash generation and rock-solid balance sheet are just fantastic. But the real star of the show here is the valuation, which gets a clear A. That big discount is just too compelling to ignore.
So the final recommendation is a buy. The whole thesis boils down to this. The market seems to be way too focused on the risks, like the cloud competition, and it's forgetting about the company's incredible financial strength and stickiness. For an investor who's willing to be patient, that spells opportunity.
And this whole thing leaves you with a really interesting question, doesn't it? If a solid, profitable, cash-gushing tech company like F5 can be so overlooked and misunderstood by the market, well, what other great businesses might be hiding out there in plain sight, just waiting for someone to do the work and find them?